Yeah, we're not enthused about gold. People historically have felt that was the first refuge from a currency that was going to be decline in value. But so's a barrel of oil, so's an acre of land, so's a piece of Coca-Cola. If the dollar goes down 50%, we will be selling See's candy for double the present price. We would not trade the ownership of those kind of assets for a hunk of yellow metal. Gold would be way down on my list as a store of value. It really is not it's not a store of value. If you're worried about paper money, and I think it makes a lot of sense to worry about paper money over long periods of time, but it's just about the last thing I would want to own under those circumstances. I'd rather have the ability to sell people a pound of candy 20 years from now, and if they're dealing in seashells, I'll get an appropriate number of seashells instead of paper money for it. I don't see gold as a store of value, and the truth is it hasn't worked very well. I see no reason, why it would work well in the future. We take it out of the ground in South Africa and we put it in the ground at Fort Knox or someplace, in the New York Fed. And it doesn't do much along the way for anybody. The one thing I would bet my life on, essentially, is over a 50-year period, not only will Berkshire do considerably better than gold, but common stocks as a group will do better than gold, and probably farmland will do better than gold. If you own an ounce of gold now, and you caress it for the next 100 years, you'll have an ounce of gold 100 years from now. If you own 100 acres of farmland, you'll also have 100 acres of farmland 100 years from now, and you'll have taken the crops for 100 years and sold them, and presumably bought more farmland with the process. It's very hard for an unproductive investment to beat productive investments over any long period of time. If you had bought gold at the time of Christ, and you figure the compound rate on it, it may be a couple tenths of 1%. I think that anytime you buy a non-productive asset, you are counting on somebody else later on to buy a non-productive asset because they think they can sell it to somebody for more money. And it's been tried with tulips, and it's been tried with various things over time, and it does come to a bad ending. In the end, you make your money out of productive assets.
Buffett starts by addressing a belief that's been around for centuries. When currencies fall, people flee to gold. It's seen as a safe haven, but he challenges that idea head on. People historically turned to gold when paper money was in trouble. But here's Buffett's take. If the value of the dollar collapses, there are better places to store value than a shiny lump of metal. He says, a barrel of oil, an acre of farmland, or a business like Coca-Cola would all be far more practical because these are productive assets. They do something. They provide value. They generate income. This is backed by real data. From 2012 to 2022, land prices in the US increased by an average of 7.96% per year, according to the US Federal Housing Finance Agency, outpacing even housing prices and proving to be a powerful hedge against inflation. Meanwhile, the gold to oil ratio has seen oil outperform gold during key periods like 2000 to 2008, showing that other real assets can protect against currency declines even more effectively than gold. Buffett paints a picture. If the dollar fell by 50%, he wouldn't be worried about gold. He'd just double the price of See's candy and keep selling. Even if people were trading in seashells instead of dollars, a business would still produce value and accept the going currency. Buffett calls gold an unproductive asset. It doesn't multiply, create, or serve. You can't eat it, plant it, or rent it. You can only hope that someone in the future will want to buy it for more than you paid. That's not investing, but rather speculation. He drives the point home with an incredible historical perspective. If you bought an ounce of gold at the time of Christ and held it for over 2,000 years, you'd still have an ounce of gold, and it would have not produced anything. Meanwhile, productive assets like land, property, or companies can keep producing value year after year. Buffett's final word on this is sharp. It is very hard for an unproductive investment to beat productive investments over any long period of time. So what do we take from this? Buffett isn't just giving a hot take on gold, he's laying down a blueprint for how we should think about our own investments. Here are some core takeaways. 1. Don't confuse safety with value. Gold feels safe because it's tangible and has been valued for thousands of years. But feeling safe isn't the same as building value. Safety blankets don't grow your wealth. Ask yourself, what do I own that actually produces something that grows in utility, cash flow, or output? 2. Productivity is the ultimate protector. Buffett believes the best hedge against inflation or currency collapse isn't gold. It's owning things that serve a purpose and solve a need. A business produces goods or services. Farmland produces crops. Real estate provides housing. Even in the worst economic environments, people still eat, drink, live, and buy. Economic trends support this. During periods of high inflation, productive real assets like land and commodities often appreciate, offering a natural buffer against currency risk. That's why diversification into tangible income-generating assets can be more protective than gold. 3. Speculation versus investment. Buffett warns that buying gold is essentially betting that someone will want to buy it from you later at a higher price. True investing is about value creation. What value is your money creating today, and how can that value multiply in the future? Let's talk real life. What can you do with this insight? Prioritize productive assets in your portfolio. Start by reviewing your investments. Ask yourself, does this asset generate income? Can it grow over time? Does it provide utility to others? If not, it might be time to rethink. Examples of productive assets to explore may include dividend-paying stocks, rental properties, agricultural land, or index funds tracking the broader market, or your own business or side hustle. Strategy 2. Invest with a long-term horizon. Buffett always plays the long game. He talks about multiple decade horizons. You should think similarly. Instead of worrying about what the market will do next week, you should consider, where will this investment be in 10, 20, or 30 years? Wealth builds with patience, consistency, and compounding. Strategy 3. Be wary of financial fads. Whether it's gold, crypto, meme stocks, or tulips, always ask, is this creating value? Or is this just hype? The moment your investment relies solely on someone else paying more for it later, you're not investing. You're gambling. Strategy 4. Use gold strategically and not emotionally. If you still want gold in your portfolio, keep it in context. Gold has had volatile price swings, including a massive bear market from 1980 to 2000, and tends to outperform only during short bursts. From 1974 to 2023, gold's price history has been riddled with drawdowns and instability. That said, gold can still play a role. Its returns are often negatively correlated with stocks and bonds, making it useful as a hedge in diversified portfolios. If you include gold, consider limiting it to 5 to 10% of your portfolio. Treat it as a volatility buffer rather than a wealth builder. Warren Buffett's view on gold is really a mirror he's holding up to the rest of us. Gold is symbolic. It represents our desire for security. But the truth is, the world doesn't reward safety, it rewards productivity. In a world of uncertainty, the best thing you can do is own things that make the world go round. The land that feeds us, the companies that serve us, the ideas that drive innovation. Buffett isn't just rejecting gold, he's rejecting passivity. He's inviting us to be builders and owners of value. And that is a powerful mindset shift. When you stop asking, what will keep me safe? and start asking, what will keep me growing? You start thinking like an investor. And that's when your financial future changes. So what can you do now? Start with this question. Am I holding shiny distractions, or am I building productive value? It's not about rejecting gold entirely. It's about making sure the majority of your energy, time, and money goes into things that give back. If you own a business, keep building it. If you're investing in the market, stay consistent. If you're learning new skills, treat that as your most valuable asset. Because according to Buffett, gold doesn't work for you, but you can build something that does. Don't measure wealth by what you can hold, but by what you can grow. Let that guide your next decision. Now I want to hear from you. What's one productive asset you own or want to own that you believe will grow in value over the next 10 years? Drop your answer in the comments below. Let's learn from each other. And if this video gave you a new perspective, give it a like, share it with a friend, and hit subscribe for more wisdom that goes deeper than the headlines. Until next time, keep investing in what grows.